We've officially entered tax season. Before getting into the specifics, the One Big Beautiful Bill does two major things. It makes key tax rules permanent, and it introduces targeted relief tied to work, family, and savings. Let's welcome our resident oracle of all things taxes, Thomas Spade, certified public accountant and instructor at the CFC School of Business. Welcome back.
So good to be back, especially with an intro like that.
Yeah, well, you're an oracle of information. And what I think a lot of people don't know about you, besides being a public accountant, besides instructing accounting students, you also write papers. I mean, you dive deep into a lot of this material.
I actually have to read some of the most complicated stuff you have ever seen, like all the regulations that come out with explaining how things are going to work.
Yeah.
Like no tax on overtime and no tax on tips.
And I think this is something that's going to catch a lot of people's ears, because many of us, we work in the gig economy, we make tips, we live off of tips,
right,
overtime, things like that. So exactly what does the One Big Beautiful Bill do, first and foremost, before you talk about tips? It kind of cements everything into place.
Well, the first thing it did was it made a lot of things from the 2017 Tax Cuts and Jobs Act, the original recipe, Trump tax cuts, made a bunch of stuff from that permanent. If that hadn't happened, then a lot of things would have gone back to what they were.
So there was an expiration date,
Yeah, it would have gone back to what it was 8 years ago.
Yeah.
So tax rates would have gone up, standard deduction would have been cut in half, would have just been a complete disaster.
Okay, all right, so let's talk about those tips.
Yeah.
So there was some question about it. When that big, beautiful bill was in the process of getting passed and then signed, everybody was wondering, all right, what does that mean exactly for me? No taxes on tips whatsoever, no taxes on overtime whatsoever, so what is the answer?
Well, the answer is there's no regular income tax on tips, but of course it's subject to limits.
Yeah.
So you still have to pay Social Security and Medicare on those tips. And if the tip, say, runs through your W-2, you still report the amount on the W-2 in full on your tax return. And then later, you calculate a deduction. Now, the deduction for it, it's $25,000. And it is also tied back to your income. So if you made over $150,000 or $300,000 if you're married filing a joint return, then that $25,000 maximum actually starts reducing. So if you make too much, and I mean way too much, then you'll still have to pay tax on your tips.
You do. Okay, what about overtime? How does that work exactly?
The way overtime works is it's going to be deducted, or the overtime would be deducted later on in the return. You still report it in full. Now, here's the thing to remember. Overtime, it's time and a half. You will still be taxed on the time. You will not be taxed on the and a half.
Right.
So let's say, for example, you have a job. You're getting $20 an hour.
Yeah.
You work overtime. And for those overtime hours, you get $30 an hour.
Yeah.
You will be taxed on the $20 that you would normally get.
Okay.
But that $10 that you normally get, that's your overtime. And then you, just like with the tips, will calculate a deduction later.
I see. Okay.
So you have to go through. It's also subject to the same income limits.
Yeah, there's a limit there.
The overtime limits are a little different. $12,500 for one person. If you're married filing jointly, $25,000. But it works just like the tips. You report everything in full on your W-2 like you normally would. You back it out later. For the overtime, you're going to have to find that out from your employer. For the tips, you can actually look on the W-2. Box 7, Social Security tips. You can rely on that number there as the number for the tips that you would then be later deducting.
Okay, all right. So for a lot of people, they think, that doesn't sound like a whole lot, but it's still more money in your pocket than it was before the
I want you to
laws.
remember, if you find yourself in, say, the 12% tax bracket, and you get $100 in tips, this just saved you $12 on your federal income tax bill. Okay. If you're in a higher tax bracket, saves you even more.
Gotcha. Okay. All right. Well, we're coming up on our first 5 minutes here, so we're going to take a break now. When we come back, we've got a lot more things to discuss, so don't go anywhere. We will be right back. Welcome back. We're here with Thomas Spade, certified public accountant. He is our source for all things tax information. We did talk about tips and we talked about overtime. So if you missed that segment, we're going to have it up on our YouTube channel. Let's talk about the new senior deduction. This is something that will apply to a lot of our viewers.
This is going to apply to anybody who is going to be 65 or older as of half a second before the ball drops and Ryan Seacrest says Happy New Year later on this year. Now, if you're 65 or older, you're going to get a completely new deduction. It's on top of everything else. It's $6,000.
Wow.
Yeah. And it's $6,000 as well for your spouse. So $12,000 as a deduction. That's after the standard deduction. Okay. That's after, or itemized deductions. That's after everything. You'll get that deduction, and that could potentially knock your tax liability all the way down to zero. Who is this designed to help?
Right.
People who get Social Security and maybe a pension or money from a retirement plan. As a result of getting more income than just your Social Security, a lot of times your Social Security ends up being taxable.
Right.
This, however, can help to eliminate that.
Okay, very good. And what if someone claims you as a dependent in that case?
If somebody claims you as a dependent in that case, then I believe you don't get it. I think you have to be the one on the return. It's you or your spouse. I don't believe that if, say, a child claims you as a dependent, I don't think they're going to get that.
Okay, all right. Let's move on to child tax credits. We've talked a lot about this in the past, but there are some things that are easing the finances for families as it pertains to children.
This has been all over the place for years.
Yeah.
In fact, there was that one time where they were actually giving monthly payments as an advance payment for it a few years ago. This year, I think things have calmed down, and I think they're going to calm down for a good long time. So here's what they did. It was $2,000 last year. It's now going to be $2,200. Okay. And this is for if you have a child who is 16 or under at year end. Now, this is also going to be indexed for inflation going forward. So that means every year it's going to increase by a little bit. So instead of it just being one flat amount forever, like it has been for a long time, that's going to be increased each year. Now, for regular dependents that are over age 16, like say an adult child or a family member that's living with you, that is still going to be a flat $500. That's not going to be changing at all.
It's not going to change. Okay. Health savings accounts. A lot of people have these.
Only those people that have a high deductible health plan.
Yes.
So if you have a high deductible health plan, the advantage of that is the premiums are cheaper. The disadvantage of that is you have to hit a much higher deductible before any of your insurance benefits hit. Nice part is once that happens, your insurance pays for pretty much everything. Yeah. But it's getting up to that deductible.
And is this insurance that you get through your employer or that you purchase on your own?
You can either one.
Either one,
Either one. Now, employers kind of like these because you can establish a health savings account and your employer can actually contribute to your health savings account each year as a tax-free benefit for you. Yeah. And then as long as you use the funds for, say, health-related expenses in meeting that deductible, then it's tax-free. But before, it was limited to people that had what are called silver plans and gold plans. Right. If you had a bronze plan or a catastrophic plan, which are the least expensive plans, then you were not eligible to participate in an HSA.
I see, okay.
One big, beautiful bill actually changed that. So if you have a bronze plan or a catastrophic plan that are high deductible plans and you don't have an HSA, go open one.
Yeah, okay. And just to end us, we've only got 30 seconds left. Any other deductions that you can take? Say, for instance, a car loan.
Car loan, yes, but you got to be careful. It's going to be on the interest that you pay up to $10,000, but there's also income limits, and the car has to be assembled here in the United States. And there you got to be careful. Yeah. Some cars that you think are very American, like a Chevy Silverado, might be built in Canada or Mexico.
Right.
Some cars that you think are foreign, like a Toyota Corolla, might be built here in the U.S. So
Interesting.
be careful. Look at the decal on the inside of the driver's door.
Something to think about when you go and buy your next car.
Oh, yeah.
Thank you so much, Thomas. Great to see you. Wonderful
Awesome seeing
information
you
as
as well.
always. We'll be back in 2 minutes.